Hi, everyone. Welcome to the AdAlta Investor Webinar. The ticker code is 1AD. We're excited to talk you through our new strategy and direction. Today I have with myself Tim Oldham, who's the CEO and MD. Tim is going to walk you through the presentation. Everyone will be on a forced mute, and at the end, feel free to submit questions in the chat box. I will then read them out and Tim can answer your questions. Over to you, Tim.
Thank you, Julia, and welcome everybody. Look, I'm really thrilled to be with you today. When I joined AdAlta in 2019, one of my objectives was to ensure that we were building a sustainable company with multiple assets in our pipeline. It's taken some time. We've been focused very much on building AD214, which is our most important asset to date. But last week we took some very, very important steps towards realizing that vision of becoming a multi-product company. And that's what we're really focused on talking to you about today. As usual, I will be making forward-looking statements and they are subject to the usual disclaimers. AdAlta is and continues to be a next-generation cell and protein therapeutic company. We've been talking about adding the cell component for some time. We've been working with Carina since 2021 in the field of cellular immunotherapies. We are very much now focused and emphasizing the cell component of that with the exclusive negotiation term sheets that we announced last week. We're a clinical stage biotechnology company. Our clinical pipeline growth is powered by our east to west cellular immunotherapy strategy, under which we're in-licensing next generation clinical stage assets from Asia and establishing those in a Western regulated environment. This leverages unique skills and regional ecosystem benefits. It provides a bridge or a pathway between Asian innovation and Western biopharmaceutical companies, and creates a series of capital efficient, short investment horizon assets that we believe will continue to add value to our company. And all of this builds our pipeline out above AD214, for which we continue to seek strategic partners for development beyond the current stage. So we announced last week the first 3 term sheets where we're now under exclusive negotiations to acquire assets under our east to west cellular immunotherapy strategy. This validates that strategy that we've been talking about for about 8 to 10 months now, and this is where we will prioritize R&D expenditure in the future. We have now, as I mentioned, executed 3 term sheets. We have exclusive rights to negotiate definitive agreements on those assets, and we're getting really positive feedbacks from investors at an asset level in this transaction and these assets, and it's very much aligned with a global trend of harnessing the innovation happening in Asia and bringing it to Western patients. We will continue to monetize AD214. It continues to be a valuable asset, offering a new approach to debilitating fibrotic diseases such as idiopathic pulmonary fibrosis. We do continue to have an active deal pipeline. I counted this morning more than 20 expressions of interest in finding out more about this asset. So that pipeline continues to be robust. Transactions are taking longer than we had hoped, but we continue, as I said, to have a very active deal pipeline there. What we are stopping to focus on our east to west strategy is our internal discovery research programs. We've determined that the pathway to a clinical stage pipeline that is and provides the milestones that are recognized by the capital markets can be far more effectively achieved through our in-licensing strategy than it can from the long journey from discovery through preclinical development and into the clinic. That's work much more suited to an unlisted company, and so we have decided to halt that internal discovery research as a better way to deploy that capital into our east and west cell therapy strategy. So let's talk about our east-west strategy. We've got very clear aspirational growth targets for this strategy, and clearly the announcements last week put us in a great position to achieve those targets. By the end of 2025, we aim to have definitive agreements in place for at least 3 advanced clinical stage cellular immunotherapy assets. They may come from the 3 we're under detailed diligence on at the moment, or they may be 1 or more may be replaced. But we'd expect the first one of those to come from the 3 assets we're working on right now. From 2026 onwards, our aim is to put one new asset into clinical trials each year. There's a substantial value inflection point to be achieved by bringing those Eastern or Asian cellular immunotherapy products into a Western regulated environment. We are combining the innovation happening across Asia in innovative T cells for solid cancers as a focus with Australia's manufacturing advantages. We're exclusively focused on T cell therapies for solid cancers as a less competitive market than the hematology cancers today. We're driven by a really robust asset selection process. We have been evaluating a large number of assets to narrow to these three that we have now secured exclusive negotiation rights to. We have a capital light model that offers a really quick return on investment potential. A single clinical trial to evaluate inflection point is possible, and we're capable of using external capital coming in at the asset level to finance these programs, avoiding the need to deploy AdAlta shareholder equity. I'd love to do that, but we don't have to. We're acting as product manager and earning our share of the value of the assets through that product management role. Importantly, this is a really highly scalable model, enabling us to potentially become an industry leader through systematically scaling out the number of products we license and expanding our pipeline. Let's turn now to the rationale for our strategy. The market opportunity is significant. 90% of all cancers are solid cancers, and they remain underserved by cellular immunotherapies, which have been amazing for blood cancers to date. We know that the cellular immunotherapy market is forecast to grow at 30+% through 2028, and by that stage will be a $20 billion market. And we know that the revenue potential from solid cancers is projected to be about half of that by that time. So we're playing towards a $10 billion market. Importantly, the FDA in 2024 approved the first 2 T-cell therapies for solid cancers, demonstrating that the technology is now overcoming the limitations and the barriers to accessing solid cancers that have been so spectacularly achieved in blood cancers to date. And we're leveraging the incredible innovation that's happening in Asia. Asia is a powerhouse for innovation in cellular immunotherapies, with 61% of global clinical trials being conducted in Asia today. Our business brings unique competitive advantages to the table. Networks combining the innovation across Asia with Australia's clinical and manufacturing ecosystem and AdAlta's capabilities to deliver pre-IND to phase 1 clinical trials is the core of our delivery mechanism. And when I talk about our ecosystem here in Australia, we deliver as many CAR-T products per million of population as the US does. That's 5 times the penetration as achieved in Europe today. Australia genuinely has advantages in delivering these therapies that we can leverage here. Our strategic sourcing is a key part of our advantage. It's a very disciplined selection of assets that are at a really key stage where they've been de-risked with clinical data demonstrating safety and efficacy in Asia, but they're yet to achieve that leap into an FDA-regulated environment. So we are licensing and securing assets specifically focused on solid cancers, specifically driven by T cells, and at a very specific point in development where we believe risk has been substantially mitigated. We're offering a unique value proposition for our partners that enables them to achieve more of the exit point and lowers our cost of access to these therapies. I'll talk again about our capital light business model. A modest investment, which is highly leveraged with outside investment, is capable of achieving a significant inflection point. We have access to capital across the globe precisely because we are facilitating investment at the asset level, not through the AdAlta parent, in order to achieve these outcomes. And AdAlta, as the asset manager, obviously owns and earns a significant buy-in to the value of these assets as a result. And it is a highly scalable business model. We've secured exclusive rights to the first 3 assets, subject to completing diligence and definitive licensing agreements, and I'll talk more about those assets later on. But let's turn to the quality of assets that are emerging from Asia today. This was the theme at the JP Morgan Healthcare Conference this week, the biopharma innovation coming out of China, specifically in Asia in general, has the potential to reshape the way the biopharma industry sources its pipelines. We now know that more than 50% of certain modalities, including CAR T-cell therapies, antibody-drug conjugates, and bispecifics, is now originating from China. We saw just before JP Morgan week, $500 million invested into 3 new companies based on assets that had been sourced from China. And we know that in 2024, 30% of all big pharma licensing deals involve a China biotech. The bottom line is that the West recognises the innovation that is emerging from Asia. And you can see from the charts on this page, the high proportion of both developers and of clinical trials that are happening in this field. But importantly, that flow of innovation from Asia to the West is hampered by a couple of problems that we are solving. The first is the lack of capital in Asia to generate the Western regulated data, the Western regulated manufacturing platforms that are required or expected by big pharma. There's a lack of Western experience and networks in order to execute those trials. And big pharma see significant opportunity costs in going back into China to validate that data, do that due diligence, extract that know-how, and establish those platforms. They also see a lack of patient diversity because obviously the ethnic mix in Asia is different to the ethnic mix in North America, which is what the FDA wants to see. So by solving that problem of extracting the manufacturing process and the data out of Asia, expanding the patient diversity in a phase 1 study that's essentially recapitulating a study that's already been done, then we're providing a unique service and a unique value proposition for both our China partners or Asia partners and big pharma. And that's illustrated in this slide, which really shows and summarizes the business model. We in-license assets from Asia at really low acquisition costs by providing the financing to the next value inflection point. Their headline is that they have now financed their asset into a first Western phase 1 clinical trial. For us, funding that clinical trial is all about our buy-in to a significant share of that asset. We build value by executing that trial, migrating the asset into a Western regulated and legal entity environment that makes it much easier for Western biopharmaceutical companies to engage with the product. It's managed by AdAlta, and that gives us our return on investment and our equity share of these assets, with the potential to be leveraged with third-party asset level investment. And then we on-license those, or we anticipate being able to on-license those to global biopharmaceutical companies through a manufacturing network that, again, we can establish and manage. There will be the opportunity for us to take these assets on further ourselves, but the business model is based on the idea that solving that pain point of extracting these assets from Asia and creating them in a Western regulated environment is the key to unlocking value and transactions with big pharma. The exits that we're looking at are illustrated by some of these comparator transactions that have happened across recent years for these types of assets. And you can see that, on average or on the median, deal values are around $80 million up front for a study, for a program that has a phase 1 results in a Western regulated environment. And that's multiples of our investment, and we will own of the order of 50% of the returns from those types of transactions. We reached a pivotal inflection point in our East to West cell therapy strategy last week. We've been working on this, I guess, in principle from 2021 when we first started collaborating with Karuna Biotech on bispecific CAR T cells. But we announced our East to West cell therapy strategy in a MOU with Synthesis Bioventures in April last year. We've established a preferred manufacturing arrangement with Cell Therapies. We have over 10 assets now in due diligence. We signed our first non-binding term sheet back in October. We've established and built out our technical team. We've now achieved 3 term sheets to in-license clinical stage CAR T cell therapy assets, that includes a restructuring of the first term sheet based on diligence findings. We now have 90 to 120 days of exclusive negotiation to close those deals. We do have backup projects in development, but our aspiration is that at least one of the current 3 will be closed, preferably all 3, The first technology transfer to Australia will commence in the second half of this year. We'll have 3 assets secured by the end of the year, and our first IND approval and first clinical trial will commence in the middle of 2026. By 2028, we would expect that we've added 1 new product every year, and that we were heading towards our first phase 1 clinical trial readout and potential exit transaction. This slide shows some more detail about the 3 assets under exclusive diligence today. There's more details about these in our investor presentation and in the version of this presentation that was lodged with the ASX this morning. But I'd highlight a few things. Firstly, the size of the markets. We're dealing with solid cancers with, even in second and third line therapies, there's more than 1.5 million patients a year around the world. All of these assets have first-in-class potential. They're either differentiated, either with armoring to overcome immune suppression and/or with a play on manufacturing to ensure that we can continue to lower the cost of goods for these products. Competitively, they are in relatively less competitive space. They all have clinical data emerging at least from investigator-initiated trials in China. And in several cases, they already have phase 1 INDs approved in China, and in one case, an IND already approved in the US. So this means there's been a degree of regulatory oversight on these, but importantly, that 10 to 30 patients of clinical data provides us with an efficacy and a safety signal for these products that doesn't exist for an asset that's only been tested preclinically. And this is the key to our de-risking strategy, that all of our assets will have clinical data ahead of us. These are highly differentiated. They've got first-in-class and/or best-in-class potential, and we're super excited about the potential of these to transform outcomes in solid cancer. So in summary, AdAlta is now very much a next-generation cell and protein therapeutic company. Our east to west cellular immunotherapy growth strategy is now validated and well in place with the first 3 assets under exclusive due diligence. 8214 continues to be an asset we believe is going to contribute significantly to the unmet needs in fibrotic diseases. It is available for partnering, and we continue to have a substantial and meaningful dialogue with a number of parties around licensing or funding the investment of that into phase 2. Now, we are continuing to build our team and networks, both for the fibrosis assets and importantly for our cell therapy program. And we have, I believe, a very attractive valuation relative to the commercial potential of our pipeline. So this sets us up really well to move forward. The important thing is we've now validated our growth strategy and that we can execute that without the need to necessarily leverage AdAlta's own shareholders' capital. We can leverage asset level investment from others. So I'm super excited that we're now in a position to make a meaningful difference to solid cancers with incredible therapies emerging from Asia. And this complements and provides us with a growth pathway ahead of and on top of our 8214 asset. And with that, I'd be delighted to take any questions that the audience may have for us today.
Thank you so much, Tim. I have some questions here in the chat box. The first one is from Dev. Okay, here we go. Though not related to today's topic, can you shed any light on the Boehringer Ingelheim Fibroneer ILD trial that met its primary endpoint? Initial data readouts from the Fibroneer trials supported generally consistent safety and tolerability profile when compared to the phase 2 idiopathic pulmonary fibrosis study. Does the aforementioned announcement reduce 1AD's asset on IPF?
So the last 24 hours has actually been a big 24 hours for IPF assets. Boehringer announced yesterday that they are now headed towards filing their next generation IPF product out of the Fibroneer study that Dev has referred to here. This is expected. They announced that trial had read out in September last year. Boehringer are the market leader today with nintedanib, and that's facing generic competition. What's really interesting about the Fibroneer trial is, although Boehringer have talked about it meeting its primary endpoints, they haven't actually released any of that data yet. And so we're not quite clear what sort of advance that is, and whether this is going to make a significant difference to patient outcomes, or whether it's really just going to be a life cycle management tool replacing nintedanib as it becomes generic in the next couple of years. What was also interesting was that Pliant Therapeutics in a phase 3 trial was put on hold by their Drug Safety Management Committee overnight. We don't know what that means. They don't have the reasons for it yet. It does illustrate the challenges of getting IPF assets approved. I'm not happy that we don't have a new project, that there's risk to that program now in the interest of patients. On the other hand, it does potentially increase interest in our mode of action, which so far has demonstrated exemplary safety. And the other thing that happened was that Roche essentially exited the IPF space by divesting pirfenidone, which is the other on-market product today, to a generic company. And on top of that, we saw Eli Lilly step into the space just before JP Morgan earlier this year with an acquisition or a licensing of Mediar Therapeutics antibody for IPF, different pathway to 8214. They paid 99 million up front with 687 million in potential milestones. So taken all together, I think we really feel that the totality of news in the last month is on balance positive for us. I think it clears a little bit of the competitive landscape forward for us. It validates that there is interest in IPF assets still, and we continue to see a number of companies, new companies being formed looking for assets in this space. And what it doesn't reflect is the number of inquiries we're now getting for the kidney fibrosis applications for 8214 as well. And our data today would allow us to pivot either way. If we were to do it ourselves, we'd do IPF, but we've got a number of discussions ongoing around people who are interested in 8214 for kidney fibrosis as well. So on balance, it's a ever-moving landscape, but the news flow in the last month or so, we think, is on balance positive for 8214.
Thank you so much, Tim. I have another question here. Can you provide clarity on the clinical trial timing? If 3 deals are signed in 2025 and 1 trial per year envisioned to begin from 2026, does that mean that the 2 of the deals signed in 2025 would not be in clinical trials until 2027 and 2028?
Not necessarily is the short answer to that question. Obviously, there's some mechanical and logistical challenges of starting multiple clinical trials in parallel. But the more pragmatic reason for that is that each of those assets are at slightly different stages of process optimization and process development. In one case, we would like to do a little bit more process development before to cement a new manufacturing process. That would potentially push it slightly longer until it enters the clinical trials, but still could be there by late 2026, early 2027. There's another one where we may actually finance, part of our financing and investment will be in a confirmatory clinical trial in China to explore an expansion of the indication. That might happen even earlier, but it won't be something we'll be directly managing ourselves. So in principle, if all these 3 deals were to reach conclusion, then yes, in principle, we could be starting 3 clinical trials in 2027. I think the point is that while these assets are now ours to decline, if you like, we don't want to predict that all 3 are going to make it all the way through. We're very, very confident that at least 1, at least 2, probably at least 2 will make it all the way through. We don't also want to over-predict the rate at which we will start new clinical trials. In part, that will also be driven by the availability of third-party financing at the asset level, as I've talked about, to progress these, and that we're running in parallel at the moment. So I think you'll see the inflection points over the next 90 to 120 days. We'll be securing the financing for these assets, closing those financing discussions that we're working on right now, and then securing the definitive licensing agreements. Once we have all of that, we'll be able to reset those aspirational targets and potentially accelerate them, yes.
Thank you so much, Tim. I have another question here. Given the current limited balance sheet of AdAlta, can you please share how this new strategy will be funded? Will this require a capital raise from AdAlta?
So the business model is one, we've worked really hard to try and think about analogies that might work for this. AdAlta is operating in this space at the moment as the asset manager. So we're identifying asset opportunities. Think of a property developer, for example. Property developer identifies a project opportunity, works to secure the land, the real estate, I think in our case, a licensing transaction, gets the planning approval, gets the development and the build plan signed up, organises all of the contractors, but at the end of the day, they then go and get third-party investors, financial investors, to invest in the project. That's the business model we're operating at the moment. And in that property development space, the financial investors in the asset get their return from the outcome of the asset, but the developer owns a share of those returns for executing the development program. And in our case, there'll be fees come back to AdAlta for managing those programs and covering the costs of all of our team to do it. So in principle, in theory, we can finance these programs without direct investment from AdAlta shareholders. Now, I would love it at some point if we were in a position where AdAlta was directly investing in these projects financially as well as from an operating and management point of view, because that means there's a bigger share of those assets coming back to AdAlta. So that's where the model goes at the moment. The beauty of that model is that we can access capital from a much more diverse range of sources and resources than we could otherwise. You know, we're talking to US venture capital firms and other investors who really don't like the idea of investing on the ASX or in listed companies. And we can provide them with a pathway that meets their investment mandates in a way that we simply can't if we were to raise all the capital through AdAlta. We do absolutely have finite capital available to us. Even to complete the due diligence exercises, you know, we do have access to lines of financing that may mitigate the need to raise capital at the moment. But of course, as a CEO, I'm never going to rule out the need to raise capital at some point. But we certainly do have, and we're working very, very hard to the extent possible, execute these transactions with minimal to no additional capital deployed by AdAlta at this point. I think it is worth pointing out, though, that the money we're investing at the moment in completing these due diligences, you know, essentially we're putting our due diligence capital at risk. If we're successful, then we will own a share of these assets purely for putting the transactions together.
Thank you so much, Tim. I have another question here about AD214. Does this announcement mean that you don't think you will get a deal done for AD214?
Absolutely not. We continue to be confident that AD214 plays a valuable role in the pipeline of assets for patients with fibrotic diseases. There are still 500,000 patients out there around the world today living under a death sentence from IPF, and probably 10 times that number from kidney fibrosis. And as I mentioned at the top of the presentation, we still have, I counted it up last night, more than 20 expressions of interest in the asset that we're working through right now. So I don't know, I certainly don't believe that AD214 is not a valuable asset. We continue to have active discussions. Obviously, those transactions are taking longer than we would have hoped. Executing one or more of those transactions may provide additional horsepower or fuel to enable us to go harder in our east to west cell therapy strategy as well.
Thank you so much. I have a subsequent question here from Pira regarding the balance sheet query that we had before. Pira's asked and acknowledged, I understand the model, but who is paying the upfront fees to the companies in China?
So the short answer to that is that the asset level investment will cover any upfront fees paid in China. Right? We've not paid upfront amounts to date to secure the exclusive negotiations. And secondly, the upfront payments are really, really modest. They'll be in the range of $2 to $6.5 million. And at the high end, that includes funding a clinical trial in China rather than simply paying for past research. So all those milestones, by and large, are paying for ongoing development of the asset, whether it's supply of viral vector or other raw materials for manufacturing, or it is conducting of additional clinical trials. And they're incredibly modest. What we're offering our partners is, instead of out licensing, which yes, admittedly, if we were going to completely out license the rights to these assets, we would be paying larger upfronts. But that would be denying our partners a share of the upside value of getting those assets through phase 1. What we're doing is, although we're formally licensing those into Australian legal entity, that means the asset is now in a legal entity that hopefully is more secure from the challenges of geopolitical politics between China and the US. The economic value is continuing to being shared with our partners. So the money we're spending is to further develop the asset, and in doing so, we buy into approximately 50% share of that asset at the end of the phase 1 program. So the upfronts, the short answer to the question is the upfronts are modest. They're going towards further development of the asset, and they will be financed in the same way that the clinical trials will be financed through the asset level financing model we're developing.
Thanks, Tim. I have a question here pertaining to the east to west cellular immunotherapy. I have here, yeah, so someone has, an anonymous person has just asked, what are the in-licensing deal terms?
So in general, as we included in our announcement last week, in general, the terms are we formally license the technology for rest of world, i.e. ex-China markets, into an Australian legal entity. For that, we will pay upfront and milestone payments in the vicinity of $2 to $6.5 million. And as I mentioned, a large part of those milestones is going to supply raw materials such as viral vector, which we would have to pay for anyway to go into the clinical trials and or to expand clinical trials in China, which are obviously more effective and cost effective than they are even in Australia. We will then be committing to the conduct of a phase 1 clinical trial in Australia most likely, although there's potential to add sites in other markets, under a US investigational new drug application or clinical trial approval. And that will happen after we've transferred the manufacturing to an Australian manufacturing site, most likely cell therapies. So the steps we're taking are move manufacturing, generate that first Western clinical data, and in return for that, we will own varies between about 40 and 65% of the commercial value of the asset at the end of that phase 1 program. And that obviously generates the return on investment when you're looking at those out-licensing deals. The totality of our investment is a fraction of the investment or the return on those comparative deals that I outlined to you. I don't think we disclose exactly what it will cost, and it will vary between assets depending on exactly what the development program looks like and the indication looks like. But it's in the order of a third or less of the value we anticipate realizing for AdAlta and our investors at the end of the program.
Thank you so much, Tim. I have another question here. It's quite a long one. What competitive advantages does AdAlta enjoy that act as barriers to entry to small biotechs here and overseas adopting a growth strategy similar to East to West? How many other groups in Australia and other Western countries are undertaking/planning to undertake a similar growth strategy?
I think the realization that the quality, quantity, and speed of innovation coming out of Asia in general and China in particular is now being realized around the world, and not just by large pharmaceutical companies, small biotechs. We know that there are a number of large pharma deals. 30% of all pharma licensing deals last year were for China-originated assets. We know that there are larger companies and venture capital firms scouring China for assets, to wit the 3 Series A financed companies that raised 500 million just before JP Morgan, all based on China-originated assets. Many of those are focused on, not surprisingly, the weight loss drugs, which are obviously one of the hottest fields of biotech at the moment. But all of those are dealing with a couple of different scenarios, which is where our advantage comes in and how we're playing differently. We're offering a completely different value proposition to most of those other programs. Other companies that are working on this east to west type strategy are focused on licensing the assets straight away and moving them into a Western company, and the return for the Chinese innovators is fixed based on the terms of the licensing deal. What we're offering is essentially a co-development where we will share with our partners the increase in value. that we get through moving it through phase 1. And that offers our partners a much higher return than they could achieve if they did a complete out licensing transaction up front. The second thing we're doing is bringing the Australian ecosystem into play. We can deliver those clinical trials at a much lower cost, but with equal quality and competitiveness than those companies can in the US. And so that combination of helping those Asian companies build the data pack they need to really do that transaction with Big Pharma in a model that allows them to share the increase in value, combined with the ecosystem that we have here, particularly in cellular immunotherapies, gives us an advantage that's going to be very difficult we believe, for others to replicate. Having said that, there are others that are doing it. Our partners at Synthesis Bioventures have done it before in the small molecule land. One of the reasons we're partnered with them is because of the experience they bring to us in delivering that cross-border transaction capability to ensure that we are genuinely adding value to the process as we go.
Thanks, Tim. And one more question here. AdAlta's East to West will focus on T-cell therapies for solid cancers. What would it take to broaden your focus here?
We've very carefully chosen a focus on T-cell therapies and solid cancers as part of our thematic around building de-risked assets. So we're not working in hematology because it's highly competitive. You know, the world does not really need another CD19 CAR T. BCMA is also becoming very competitive, and there's only a finite number of hematology indications. So we don't want to go there. We're also not planning to go into autoimmune disease, again, because that's largely repurposing all those hematology cancer targets. It's a natural line extension for those. The big untapped opportunity is solid cancers, and we are now starting to see that with the first FDA approvals that we're able to solve that challenge, the additional challenges that solid cancers pose for us. We're focused on T cells because we know today that T cells are the most potent immune cell out there. It is clearly being demonstrating greater potency and durability than some of the other approaches. I'd love to see NK cells, for example, get there with the allogeneic potential, but at the moment they just don't have the durability and horsepower yet to persuade us that that's somewhere where we warrant to go given the risk appetite we're trying to take. So yes, with additional clinical data demonstrating durability and efficacy and potency, and additional manufacturing data showing that we can genuinely scale those to being multi-dose product potential or allogeneic potential, one donor to many patients, then we look at those. But I think it needs that additional clinical data and evidence to support that to fit our business model. And certainly we're not going beyond T-cell immunotherapies and cellular immunotherapies. Yeah, there's a specific set of advantages that we can combine in Australia and China in that field that perhaps don't exist in other modalities. But in coming up with the strategy originally, we did look at a whole range of other modalities. There's been a very robust process gone through to select this field to operate in particularly.
Thanks so much, Tim. Wonderful and insightful webinar. If anyone has any additional questions, feel free to email me at julia@thecapitalnetwork.com.au. Thank you so much for your interest in the company, and have a lovely day. Thank you, Tim.
Thanks, everybody. And just in closing, just to reiterate, yes, we are early days in this. We understand that there's a journey that people are going to go on as they understand where our strategy is going. We're very hopeful that in the very near future, we'll be able to add some fairly significant additional detail around these assets, some significant detail around the financing that's coming behind it. I'm super excited about this opportunity for our company and look forward to updates in the very near future.
Thank you so much, Tim. Have a great day, everybody. And thank you again for your interest and support.